Hello, welcome back to the channel. In this video I want to tell you what dividends are and how you can include them in your investment strategy for passive income. But before that, I would really appreciate it if you like the video and also subscribe to the channel to get more updates. I'm going to be covering topics that you will probably find interesting. Also, down below in the description you will find a link to a blog post that I made about dividends on my website. As I promised, this video is all about dividends. And you may be wondering, what is a dividend? Well, to put it simply, a dividend is a payment that a company makes to its shareholders for owning a stock. And it comes from the earnings and cash flow from the company. And to give you an idea of how dividends work, imagine you own one share of fictional company XYZ that pays a yearly dividend of $4. In the US, typically companies will split the dividend into 4 pieces, into one for each quarter. So instead of receiving one payment of $4 per share that you own, you will receive $1 per quarter per share. And those are $4 of completely passive income you have. You only have to put the time to do the research on the company first and then put your money. But after that is just collecting dividends as they come. One disclaimer that I should point out is that dividends are never guaranteed. A company could just decide to stop paying them and you are left holding the stock. However, there are many companies that have stood the test of time of paying dividends increasingly every year for many years. One such example is the group known as Dividend Aristocrats, which I will be making a video about soon. Those are companies that have paid dividends in increasing amounts each year for at least 25 years. Examples of those are AT&T, Johnson & Johnson, Coca-Cola, and there are many more. I'll be making a video about it soon. One disclaimer that I should add with this investment strategy is that it's a very long process. You either need a long time horizon or a lot of money up front to get started and have a decent chunk of cash flow. And the reason for this is that dividends are rather low. The S&P 500, the index that tracks the 500 biggest companies in the US, has a dividend yield of around 2%. To put it into perspective, if you wanted to make $50,000 a year from dividends, you would need to have $2.5 million invested into the S&P 500 to generate that much cash flow. Most people don't have that much money, but the good news is that you can compensate if you have time. You can start investing early and compound your growth, and I'll talk about that now. To use time in your favor, you need to know the concept of dividend reinvestment. That is the idea that when you get paid a dividend, instead of taking it out of the account and using it for something else, you reinvest it back into your portfolio, whether it's reinvesting into the same company that paid the dividend or into a different company that will pay you dividends as well. The idea is that when you own a stock that pays a dividend, like in our example with XYZ, you will take that dividend, that $1 as it comes, you will reinvest it to buy more shares of XYZ, so the next payment, instead of getting just $1, you will get a fractional increase. And the next time you will get a little bit more, the next time a little bit more, and little by little you will be growing your money. So each time you get paid, you get more shares. So next time you get more payment, you can buy more shares, and that's a rolling effect. Of course, that can take a long time, so you should be adding money to your portfolio as well. So from your job or from your wages, whatever you have, you can put it there to keep it growing. And eventually you might reach a point where your dividends can sustain the growth of the portfolio much quicker than what you can put in. The idea is that by the time you retire, you will have set up this passive income stream that just pays you for owning the stock. You don't even need to sell it, and you could even pass it to your kids because it will keep paying dividends as long as you chose good quality companies. There are a few things that you can take into account. One is that you can buy an index ETF like the SPY that pays rather low dividends, but it's usually considered more stable because you're invested in the market as a whole and not individual companies. Then on the other hand, you have individual companies like I mentioned before, AT&T, Johnson & Johnson, Coca-Cola, which tend to have much higher yields than the S&P 500. But it's riskier because you're investing the money into one company and you may pick wrong. But you have to make that decision on your own and see what works for you. But I would advise you to try to stick to companies that have a proven record, that are high quality companies, known companies around the world, and usually high market caps. Don't try to chase yields. There are some companies that will offer like 10-12% yields on your money, and that might sound good on paper, but usually those are companies that are not very stable. Sometimes they cannot even pay the dividend and they have to cut it. When they cut it, you not only suffer the loss of the money, but people usually start dumping the stock and selling it, and your capital will also be lost in the process. So you have to consider those risks. Finally, I want to make a point about taxes. when you get a dividend, you automatically owe taxes to the government. And I'm talking about the US case. But keep in mind that I'm not a financial advisor, tax advisor, anything like that. I'm just a random person on the internet. So just do your own research. But when you get a dividend payment, you owe taxes automatically on that money. And you're taxed as regular income. And this is different than to invest in companies like Facebook, Amazon, Netflix, or other growth stocks, where the price appreciation doesn't necessarily mean you pay taxes. It's only after you sell. So if you bought Facebook at a certain price and you're now at 1,000% capital gains, but you haven't sold, you still don't owe taxes until after, when you take profits. With dividends, it's different. Every time you get paid, you owe taxes automatically on that money. That is unless you're using a few of the retirement accounts like a Roth IRA, where you can counteract that effect. But I won't cover that here, so you should research that topic if you're interested. So that was all I wanted to say about dividends, but if I forgot something, you can let me know in the comments. Also, if you are invested already in dividend-paying stocks and you have some favorite companies, please let me know your reasons and the stock symbol. I always like to find what other people are investing into and maybe get good research ideas for later. And if you like this video, you can like and subscribe to the channel so you can get updates every time I post a new video, and I will be covering this similar topics that you will find interesting, I hope. So you can also check my blog down in the description, and I'll see you next time. Bye.